So support and resistance can be a very basic concept which all of us understand. All of us understand this, that when prices are in a downtrend and prices are coming down, it might reach a stage where, so when it's coming down, we know this for sure, that the relative supply is greater than that of the relative demand. Means the willingness to sell at a lower price is higher than the willingness to buy. Now, when it's a downtrend, it's getting cheaper, right? And because it's getting cheaper, it will have the interest of institutional investors to buy at a lower price. Now, how does a support shape up? Is, let's say it comes down to a price of close to 100, and the relative supply dries down, means people are no more willing to sell at such a low price. They will use a bounce back to sell. On the other hand, those who were willing to buy, they find that 100 is a very good low price to buy, and at this juncture the intensity of buying overcomes the intensity of selling, and it leads to some kind of buying pressure and prices bounce back. If the supply is not over, fresh supply comes in. Fresh supply means fresh selling. People who have not managed to sell at higher levels will use bounce backs to exit. And if this level of close to 100, every time if we see that buying comes up, this is the kind of example that we saw when we did that accumulation from institutions. See over here, every time it comes down to a lower price, they bring in their buying. And so what happens, because of the institutions bring in their buying, bring in their demand, support forms. We see it in the chart that a certain level is held by the market multiple times, and this can lead to a turnaround. Same thing, when they have to sell out, they will obviously have a certain price in mind, and when they have this certain price in mind, every time it comes close to there, they sell. Their relative selling, their willingness to sell at this juncture is higher than that their of willingness to buy, and so the distribution happens, and this we call resistance. Easier said than done. Our work will be to understand, realize where are these supports and resistances, and what will happen if a resistance is breached and if a support is breached. I will give you some practical examples, but before that, let me walk you through the psychology of support and resistance. Let's try and understand one thing. Let me take you to a new page. Let me draw an example where the stock price is coming down. And we see a chart that twice the stock had bounced back from 100. And we tell ourselves that this stock has a support at 100. Now, two types of traders are always there in the market. One who's a buyer and the other one who's a seller. Shiv is facing a little bit of problem. He says that the screen is not changing at his end. You can see only the God page. Is that the case with everyone? Can you see the support and resistance? The support at 100 rupees, falling chart drawn in black ink. If yes, please you just write that the screen is changing. Okay, thank you. Thank you. Perfect. All right, perfect. So, as I was saying, that two types of traders will be here at this juncture. One who will be willing to buy and the other person who will be willing to sell. Now, two persons probably looking at the same chart, one will say, well, the level of 100 is holding really well and I should be looking to buy next time when it comes to 100 and holds above 100. So he has a bullish view. On the other hand, the other person who's looking at this chart and he sees that this stock has corrected from 200 to 100 and it's in a very, very weak trend, he has a bearish view and he decides that if 100 breaches, then I will go short, I will sell it. So one person has, looking into the same chart, creates a bullish view and waits to buy close to the 100 level. The other person, looking into the same chart, believes that the chart will fall further and he has a bearish view. It's completely all right. Now what happens? If stock comes down close to 100, the bull trader, he adds here, he buys on the anticipation that the stock will bounce back. Let's say it bounced back a little bit, but then eventually it breaks the support. The moment it breaks 100, the support, the bear trade is activated and he shorts, he sells. Let's say the bearish view goes right with the trend and it comes down to, let's say, 95. And if it falls further, let's say comes down to 93 or 92. Now at 93, 92, the person who bought is not very happy at all. But on the other hand, the person who shorted is actually making a quick buck because he got his analysis, research, and trade right. What the bullish guy will do here, because he has gone wrong, at 93, he will use what is known as averaging out. So what he will say is, okay, I bought at 100, let me buy some more at 92, 93. It will take my average costing down, and if I get a bounce back, I can book out. So the person who was bullish, who bought at 100, at 93, he buys again. The one who was bearish and who shorted the stock and his view was right and he's sitting on a nice quick profit, he will decide that this is a nice place to book some profits. So what he will do, the person who was bearish will also buy. So at a lower level, both the parties infuse buying, demand. One buying is buying its original position, averaging out its original position, and the other buying is covering its erstwhile shorts. Because of this, we generally, you will notice, because of this, bounce backs are very sharp in nature. So the stock bounces back. Now, if this stock bounces back further and comes close to that 100 mark again, what will be the bullish guy think? He went wrong in the first instance when he bought at 100. It fell to 93. He did some daring and he averaged out at 93. Probably his costing came down to 96 and a half, 97 and a half, depending on the quantity that he buys. And the stock goes back to the level of 100. What he will essentially do is, as because he went wrong, he will take out his marginal profits or cost to cost and he will exit. He will sell, get out of it, because that was his objective, to take the cost down, use a bounce back to exit. On the other hand, the bearish guy who went right, his research analysis was right, his trade gave him some quick profits. He finds that the stock is back to that level where he had earlier shorted and made some money. So his view of bearishness will continue and he will also infuse some selling. So both the parties, when they started with a differing view, now shares the same view and the stock corrects down. So moral of the story over here is, if you notice, earlier it was a valid support. The 100 was a valid support. By valid support, I mean that multiple times tested. At least two times. So one cannot hold. So at least twice. So when we see a price bouncing back from a level at least twice, we say that it's a decent support. The more number of tests, the better the support. And once this support is broken confidently, comfortably, and if prices come back to those levels, the support changes its behavior and becomes resistance. This switch of nature from a support, it changes its nature and it becomes resistance, and vice versa. Once a resistance is broken, it again changes its nature and becomes support. This shift is called the polarity, the principle of polarity. This is very useful. You will find it all over the charts. I'll take you to some practical charts and will show you how this works. But remember one thing, once you spot a valid support or a valid resistance, valid means more than twice test of that level. And if that level is eventually broken in the future, then quickly it will reverse its nature. From a zone of buying, it will become a zone of selling and vice versa. This principle is called polarity. Now, before I take you to charts and show you this concept further, just remember one thing, that supports and resistance may not always be horizontal. This example, you would have noticed that the support line or the resistance line, let's say, wait 1 minute. Let's say this is a level where the stock goes, corrects, goes, corrects, goes, corrects. I can clearly see that this is a resistance. And if finally this resistance is breached, this support, this resistance will change its nature and become support. And it will give you support like this. Now notice that this line was horizontal. This support as well as resistance line, the slope was essentially flat, it's horizontal. That may not always be the case. You might have instances where the lines are maybe rising or the lines may be falling. So you can have instances where the stock finds resistance twice, thrice, and when finally it breaks, it will try to find some support. And vice versa, it can be other way around, where let's say the stock is giving some resistance, and once it breaks down, it will tend to give you once, twice, thrice support. This is on a rising, falling, and it can happen the other way around also. That earlier it was giving support, then it gives resistance. Both these examples are first resistance and then support. Support giving resistance. Let me quickly keep it in this because I'm drawing them, so it's better that I keep it in this page itself. So what will happen? Prices comes and finds some support, comes back and finds some support. So every time it's giving support, the support is breached, broken. Every time it bounces back, now it will try to find some resistance. Right? Now let me take you to some practical examples. Spider software again. Candlestick chart. Once I'm done with candlesticks, once I'm done with the support and resistance concept, I'll take you to candlesticks, some basic candlestick patterns, and obviously then followed by the Heikin-Ashi candlestick. So let's go to Nifty. All right. You notice over here recently, look where I have kept my cursor. If I come to the early month of July, all of us would have clearly seen that close to 9690 means 9700, there is a decent resistance. Once, twice, thrice, right? So this was my resistance. And please remember one thing, that the markets do not probably behave by the decimal point. It's always like a band. So the way I see it is, I see that there is a resistance, and the way I will mark it is something like this. And this. Once we have the software, I'll let you do all these things that I'm showing you. You will be able to do all these things. So let's go back. Let's come here. Yes. So over here in the 7th of July 2017, 9700, 9690, 9700, this 10-point band was a clear sign of supply, no doubt. What happened after that? The market, depending on its demand supply scenario, it broke out. And it was a clean breakout. It never went back, it just shot up. Thanks to short coverings, it just shot up and it went further up, making a higher high, higher low. But eventually, when we got a sell off, look from where we got a bounce back. This is an example which I showed you right now. It's right there, recent behavior of our Nifty chart. The erstwhile resistance becomes the present support. Right? Now look over here. Look over here at this juncture. I'm taking you to a smaller scale. When this fall was happening, it kind of bounced back one day from this level. One day bounce back. In this entire fall, from 2nd of August to the 11th of August, there was only one day of bounce back from the lows from where the price bounced back. This was the only one day. And that low was around 99.88 over here. It broke, and if obviously this is not a valid support because it is just got one day. But notice over here also where I've kept my cursor. This one day's low from where the market found some support, as the index comes back, exactly that is where it is facing some amount of resistance as we speak now.